Question 33. We have two questions in this for this problem. First one, this company owes $13,000 to an unsecured creditor without priority. How much money can this creditor expect to collect? Question 2. B. This company owes $120,000 to a bank on a note payable that is secured by a security interest attached to property with an estimated net reliable value of $90,000. How much money can this bank expect to collect? To solve these two questions, the first step is to prepare the statement of financial affairs, and let me show you what this statement looks like based on the information we are provided in this question. So this statement of financial affairs is going to have two main components. One is the asset, the other one is the liabilities and the stockholder equity part. So now it looks a little bit like the balance sheet, but those when we break it down, as you can see that's still quite different from a typical balance sheet. So under asset, the first item we will have is called asset that's pledged with fully secured creditors. In other words, those are the assets can be used to pay for some of the creditors. By looking at the information we are given here, so the asset pledged with fully secured creditor is $220,000, and this amount of asset is used to be used to cover the fully secured liability of $160,000. So that's why we have this asset under pledge with fully secured creditor $220,000, and it's going to be used to cover there's liabilities that fully covered by this asset. In the question, we don't know what that liability is, account name is. Let's assume that's just a note payable. Okay, so the total value of notes payable is $106,000. It's fully covered by that asset. And after $220,000 is used to cover the liability, they still have $60,000 left, and those unused amount is going to be available for unsecured creditors. Okay, now let's move on to the other accountant. The other item is other asset is those are assets with partially secured creditors, which means that the asset itself is not big enough to cover the whole liability. So the asset amount is $390,000, and as to the liability it's going to be used to cover is another notes payable, and the total is $510,000. You see that is not enough to cover the total amount, so that's why it's called partially secured credit. That's why it's called a pledge with partially secured creditors. And then, which means that nothing is available for unsecured creditors from those assets. And there are some free assets. Those are assets not pledged. In total, it's $310,000. So number is here. It's given $310,000. Okay, so we just skip this assets with partially secured creditor. That's $390,000. We just introduce that amount, and the partially secured liability is $510,000. We just use that as well. Okay, so then we kind of need to focus on this column now, and we can see that the total available to pay liabilities with priority and unsecured creditor is it's going to be based on the amount that's left over from those assets pledged with fully secured creditors and those free assets without have not pledged with any creditor. So in total that is $370,000 they can use to cover those liability with priority and unsecured creditors. Okay, so The other part we kind of need to wait, even though we have already input the numbers, but all the numbers that come from the liability and the stockholder equity part. Okay, so let's move on to next part of this statement and then come back to those numbers later. Okay, so next let's prepare these liabilities and stockholder equity amount, equity part, and under these liabilities and stockholder equity, first is the liabilities with priority, and those are the payment for the salaries of their accountant and their lawyer or anyone they need to have to maintain their operation so that they can go through this whole liquidation process. Okay, the total amount is 182,800, and this is the amount that is also shown here. Okay, so that's unsecured liability with priority, remember. So they have the priority, which means they have to be paid first. Okay, so $128,800 is the liability with priority, and that's also the amount we used here under assets. Okay, and then let's go back to the asset part. We use the total available to pay liability with priority unsecured creditors and minus this liability with priority, then we get the amount for unsecured creditor, that's 187,200. Okay, so now let's move on to the liabilities again. So under liabilities, the first part are those liabilities with priority, and then let's move on to those creditors, whether they're based on whether they are fully secured or partially secured. First are those fully secured creditors, and that's a notes payable. We just assume that the total is 160, and the company do have enough asset to cover that the total amount of that notes payable, which means that nothing goes to the unsecured part. So this is another important part. Important column here. So so for those fully secured creditors, they get everything covered and they're fine. And then we have those partially secured creditors. In total, that's another notes payable, and in total that's 510,000. However, we do not have enough asset to pay for it, and they only have 390,000. So the remaining 120,000 are unsecured. Okay, so that 120,000 goes are the unsecured from the partially secured creditors, and there's additional 400,000 that's unsecured at all. Normally those are like some accounts payables they cannot pay. So in total, the unsecured liabilities are 520,000. So this is a number we have here. The reason I put that here is that we need to know. So in total, they have the total amount the company have available for the unsecured creditors is 187,200. But in total, they owe them 520,000, which means that there is an estimated deficiency of 332,800. Okay, so let's come back to the questions. The company owes 13,000 to unsecured creditors without priority. How much money can this creditor expect to collect? So here, and we know that not everyone can get their for those unsecured creditors, they are not able to get fully. I mean, they cannot have their loss fully covered. Only a part of their liabilities can be paid, and there's a percentage. Is that we use the total available fund divided by the total unsecured liabilities. We get 36%, which means that every unsecured creditors can get 36% of the liability back. 36% of the company owed them. The amount the company owed them back. So for these creditors, because the company owed them 13,000, so they can get 36% of 13,000 back, which is $4,680. Okay, next question. This company owes 120,000 to a bank on a note payable that is secured by security, interest attached property that estimated variable value. Okay, so for this bank, they can cover 90,000. So this is the partially secured part, but there's the remaining 30,000 is need to be collected based on the percentage you just calculated. So which means that for the bank, it can get 90,000 and plus 36% of the remaining amount. In total, that's $100,800.